Okay, I think we'll get started now. Are you there, Brett?
I am, yeah. Can you hear me?
Yes, I can. Very good. Very good. Well, I think there might be a
Right.
few latecomers, but I think we get started now. Thanks. Welcome to today's webinar. I think the nation let out a sigh of relief yesterday afternoon with the news of moving to level 2. So it's great news, but I suppose time will tell, I guess, over the next couple of weeks. Thank you for taking the time out to attend this webinar. It will be a good one, very topical. In the side panel, please do ask questions throughout. Remember, there's no such thing as a silly question, so please ask away. We'll try to cover off these questions at the end, depending on how long it goes. But if we don't, then you'll be sure to hear from us afterwards with answers to those questions. My name is Justin Keane, and I am a co-founder of BetterCo. For those that do not know BetterCo, it is a merger of Cloud Accountants, which began in 2009, and NextGen Accounting, which began in 2012. The company is jointly owned by myself, Alistair, Peter, Niren, and Vinay, and we all have the same desire to see people run successful businesses and live the Kiwi dream. So thank you for tuning in. We know you will get some valuable information today, and I urge you to take notes during the process. I'll now introduce you to Brett, who will say a few things about himself before the start of the webinar proper. I will add that we have many colleagues in the mortgage advisory space, so if you would like us to introduce you to these experts at any time, please do get in touch. Over to you, Brett.
Thanks, Justin. And I'd just like to say good on BetterCo for the initiative. It's I've had a lot of feedback from people's accountants, or about people's accountants during the lockdown, and a lot of them have just gone to ground. So, which BetterCo has been very proactive. So, well done. So, just a brief introduction to me. So, I've been a mortgage advisor for 11 years, since 2009. So, I started in the depths of the GFC. And previous to that, was a senior manager with mortgage lenders both here and in the UK. So been about 20 years in the mortgage industry now, and these days we've got a client base of around about 1,000 clients, and we settle about $65 million worth of loans per annum for our clients. So that's what about me.
Thanks, Brett. What I'll do now is just quickly run through the agenda. There's quite a bit to cover off, so we'll have a look at the interest-only and mortgage deferrals, the current lending appetites of each bank, and there's been some news recently and some movement there. What hoops do you now have to jump through to get a mortgage approved in this environment? What options are there outside of the banks? The LVR restrictions being removed and some commentary around that. Things to be wary of when approaching banks and going through the purchase process. Interest rates, very topical at the minute. Bit of crystal ball gazing. Is it a good time to buy? And refinancing for better rates and debt consolidation. And then lastly, how do you build resilience into your mortgage structure? So we'll work through all of these parts, and Brett will be able to provide some good commentary. So in our last webinar, I'm not sure whether people attended that one as well, but Niren and I discussed the mortgage holidays and interest-only payments. Now, Brett, can you talk us through what they are and the pros and cons of each?
Yeah, sure. So, mortgage holidays and interest-only options, they've always been available from banks, but they've normally been extremely difficult to get. So the difference is now, basically, if you ask for a mortgage holiday or to go interest-only, you will get it, and it's a pretty simple process. So, for how long they remain options, and it's that easy, that remains to be seen. But hopefully, that's going to be for a while yet, because there's certainly some pain to come. So when you talk about the mortgage holidays, there's certainly no holiday. So most of the clients we've talked to over lockdown once we've talked with them and explained how the mortgage holiday works, they actually don't want to do it. So although it's a holiday from the payments, it's not a holiday from the interest. So probably a better term for it is the mortgage payment deferral. So what it is, you can have no payments on your loan for up to 6 months, but like any holiday, you'll pay for it eventually. So you'll still get charged interest daily on your mortgage, and that interest gets added to your loan regularly, and it compounds. So over the time, your loan balance increases, and so at the end of the payment deferral, your balance is bigger, and also your regular payment will be bigger. So the other option, which has proven to be a lot more popular for our clients, is changing on to interest only. So again, you can have up to 6 months of being on interest only. The beauty of that is that the balance doesn't increase. And at the end of the 6 months interest-only period, your payment will be a bit bigger, but it won't be as big as what the payment would have been with the payment holiday option. So, Justin, if you could flip to my screen, what I might just do is run through an example, if that's right.
Yeah, yep, let me do that now. Hold on, right. There you are.
Okay, can you see my screen there?
Yes, I sure can.
Okay, so on my website, I've embedded a calculator to help clients understand what the mortgage holiday or going into interest only actually means. So if you want to check it out, just search, do a Google search for loan market rate. That'll take you to my webpage here, and then you can see here payment deferral, what it means to you. So click on that, and that takes you through to the calculator. So here it is. So let's say, for example, we had someone with a $500,000 loan. So you put your loan detail in there, and then you put in how many years you've got left to run. So let's say we've got 20 years on left to run. Let's say the current interest rate is 3.5%, and we want to pause the loan for 6 months. So then down here, you've got the options of checking out what principal and interest to mortgage deferment means, or what principal and interest to interest only means, or if you're already on interest only, what interest only to mortgage deferment means. So let's start with principal and interest to mortgage deferment, hit calculate, and this spits out the results for you. So in this particular circumstance, the end of the 6-month mortgage deferment or holiday, the balance would be $8,814,000 at the end of it, and the payments increase by $103 per month. You can change the frequency of payments up here. And then also you can go into the payment table and you can work out for all the different years what it's actually going to mean for you in the long term. So it's quite a handy calculator, and then you can do the same thing for principal and interest and the other options as well. So yeah, quite a handy tool. So yeah, back to your screen, Justin.
Yeah, that's. I'll just add something here. I actually went through this myself, and yeah, it's quite eye-opening. The increase in interest if you just go on a proper deferment or holiday, it really is. So no, that's good, Brett. Hold on, let me just change back.
Yeah, clients have been really liking that, having more of an understanding of what it actually means to them. So give you a bit of an example. We had a client call up last week. He lives in Devonport. He's the major breadwinner for his family, and he's got an $800,000 loan, and got made redundant last week. And yeah, that sounds pretty scary, being made redundant with having an $800,000 mortgage. Luckily for him, his fixed rate is just about coming off. It's due in June, and we're going to chuck him on a 1-year fixed rate of 2.99. And we're going to put him on interest-only payments, and that means that his weekly mortgage payment's only going to be $460 a week, which when you consider that's a lot less than you pay in rent over there. So he's pretty happy with that, and he thinks he's going to be okay.
Yeah, good.
So if you take a look at, sorry, do you have a question, Justin?
No, you go.
Yeah, if you take a mortgage deferment or the interest only, banks are telling me that they will look at you a bit more critically for the following 6-month period after you've finished that option if you're looking for new borrowing. But as long as you can provide detailed commentary around why you took it and you can demonstrate a clear ability to repay the loan you're requesting, it's not going to stop your future borrowing ability. And you just got to remember, this is a crazy event. It's not anyone's fault. Hundreds of thousands of mortgage holders have done this and are going to be doing it. If your income's looking shaky and you don't have a sizable nest egg, then don't be too hard on yourselves. It's going to be a tough year. And if you chew through, if you continue with your big mortgage payments and you chew through your savings because your income's down and you get to the bottom of the barrel, it's going to be really difficult to borrow anymore. So finding yourself in that situation, in my opinion, it's probably better off keeping yourself as financially strong as possible for the next 12 months. And this is going to be the easiest loan you're ever going to apply for.
Yeah, you did right. And as we all say, cash is king. So if you can defer some interest payments and hold on to some cash during these times, which are uncertain, then that's the best way to go, isn't it?
Oh, agreed. Yeah.
Cool. So let's just, are you ready to move on from that one, Brett?
Yep, all good.
Very good. So the lending appetites of the banks. So how are you finding banks' lending appetites at the moment? Are they wanting to lend at present, or have they shut up shop completely?
Well, I guess it's a very quickly changing environment at the moment, Justin. So words that we're hearing every day from the banks are careful and prudent, and you'd expect that. That's pretty sensible stuff at the moment. If you were lending out your own money to people right now, you'd be pretty careful too. So, but yes, banks are still open for business. I guess it's pretty important to note that the New Zealand banks are much better capitalised, they're more liquid, and they have stronger balance sheets than where they were when the GFC hit, the global crisis. So, right through the lockdown, we have been getting applications approved, and it's been for a real mix of purposes. It's been for new owner-occupied home purchases, investment property purchases, quite a few top-ups for debt consolidation, home renovations. They're quite popular when everyone's stuck at home for 2 months, and refinancing for better rates as well. But the banks are all taking quite a different sort of approach at the moment. You take BNZ, for example, they're not overly keen on new loans right now. And we're finding that they're declining quite a few applications that they would normally be writing. But they're looking at if you're not an existing BNZ client, then they're probably going to ask you for quite a big deposit, around about 40%. And for their existing clients, they're only looking to lend up to 80% of the value of the property. And for investment properties, that's still only 70% for now. ASB Bank, they haven't changed too much actually, so they'll still do 80% loans for new to bank clients, and they are telling me they're open to 95% loans for existing clients, but I expect very few of those to get approved. And for investment properties, they're still working on a 70% lend, so you still need the 30% deposit, but that will probably change. ANZ Bank, they have been quite good. They're doing up to 90% loans for new to bank clients and existing clients. But if you're looking for anything over 80%, you have to be a first home buyer. And investment property loans, they're still at 70%, but they are saying they're about to change that. Westpac Bank, we've been getting quite a few through them. They'll do 90% loans for new to bank clients and for existing clients, and you don't have to be a first home buyer. For example, you might be upgrading your home, and they're also part of the Kainga Ora first home loan, which used to be the Welcome Home loan, so you can go up to 95% with them as well. Kiwi Bank, they have been quite good. They are doing up to 90% for new to bank clients and also for existing clients, and they are already doing up to 80% for investment properties. Yeah, cash contributions have changed a bit. Before the lockdown, we were getting up to 0.8% of your loan amount as a cashback for clients, and that's gone down to between sort of 0.3 to 0.55. Some banks aren't doing any cash. But that's probably going to improve over time, and you know, they've already come up slightly from where they were a few weeks ago. You know, the reality is that loans over 80% of a property's value, they're going to be hard to get. It's changing daily, so you know, my team and I are checking in with the banks every couple of days for updates.
Yeah, and that's what I was just about to say, Brett. I suppose it is changing on a daily basis, and you just got to keep up to date with what the banks are offering, because they seem to be coming out with announcements every day.
Oh, absolutely changing extremely rapidly as they sort of try and suss out where things are going, for sure.
Yeah, that's it. Cool. So we'll move on to the next slide if we can. So, yeah, I mean, we talk about it all the time, but obviously things have changed pretty dramatically from where we were 2 months ago. And banks will be a lot pickier. What's different now in terms of what applicants are having to provide to the banks?
Yeah, well, you know, it was a reasonably frustrating experience for applicants before the lockdown even happened, but it's a fair bit harder now. It's all sensible stuff, and you know, anyone who's applying for mortgage finance at the moment, you know, you should be doing this homework before you're taking on a new debt in this sort of environment. Yeah. Basically, you know, half-cooked mortgage applications, they're not going to get approved in this environment. You have to be putting together you know, good quality submissions to the banks, otherwise they're just not going to look at them. Yeah, so I suppose when you're looking at PAYE wage earners, you know, what they're having to provide is, you know, a commentary about how their income has been affected by COVID-19, and also confirmation for customers returning to work following the lockdown period, and they want to see, the banks want to see a written confirmation from their employer that that is actually happening. Yeah, a lot of people have been had their incomes reduced down to 80% or even more, sorry, even less. So some banks are only using the current income, even if you're about to go up back to 100% again. And you know, if you make commissions and you do overtime, then the banks are going to be looking for written confirmation from your employer about the ongoing sustainability of those. You know, for self-employed applicants, you know, it's always harder getting a mortgage when you're self-employed. So, of course, it's a lot harder now. So, you know, and the impact of all of this is, you know, varies from business to business and across different industries. So, what banks are looking for essentially is a really solid commentary from the director of the business. Things to cover off, things like, you know, how has the business met its financial obligations during the lockdown period, for example. What cash resources does the business have? What are the existing overdraft limits? What government assistance has the business taken over the lockdown? How has the business income been affected by COVID-19? If so, what's the impact been? You know, what are the business income expectations for the remainder of 2020 and beyond? So banks are looking for updated cash flow forecasts detailing those future income expectations, and they want to know the assumptions around those forecasts. They're really important. They want to see your March 2020 financials. If you haven't got those ready, then they might look at GST returns, and then they want to look at things like any GST or tax that's due for payment, details of current age debtors and creditors, all that kind of thing. Yeah, it's all gonna help.
So it sounds to me, Brett, that us accountants are going to be quite busy preparing some of this stuff for our clients. Is that right?
Oh, yeah, absolutely. You know, just you know, and putting through forecasts where every month the numbers are exactly the same, and that's probably not going to cut it. They're going to want to know you know, that it's really been detailed forecasting done, and like I said, all the assumptions behind it are going to be really important as well.
Yeah, that's what we're seeing already anyway. So, and we're doing quite a number of those for our clients currently, and just doing scenario testing as well across those forecasts, which is pretty important. And the banks love seeing that sort of stuff. So, we've given some really good thought and discussions with the business owners.
Yeah, absolutely. I think anyone who's not providing, if you're self-employed and you're not providing that with your mortgage application, the bank's going to be scratching their head a little bit and thinking, okay, is this business actually, do they have an understanding of what's going to be happening going forward? So pretty important stuff.
Yeah, that's right. Cool. So, yeah, so in the lead up to the GFC, a lot of finance companies failed, taking people's life savings with them, which was, pretty bad at the time. With bank lending criteria being so tough, what other options are there out there, and how safe are they?
Yeah, well, in this environment, banks will be declining applicants that they previously would have loved to have on the books. They would have welcomed them with open arms. But so I guess first things first, if your bank declines your application, then bank B, bank C, bank D, they may still approve it. So it's worth trying the other banks first before giving up completely or going to look at the non-bank lenders. There are a few non-bank mortgage lenders that have positioned themselves pretty well to pick up the clients that the banks would have happily approved a couple of months ago. So to give an example of one, there's a company called Resimac. So they've been in New Zealand for about 7 years. They've been in operation in Australia for about 35 years. So they're the biggest non-bank lender over there, and they're one of the few non-bank lenders that survived the global financial crisis. So they're actually funded differently. So they're funded via bank warehouse facilities. So basically what that is a massive bank overdraft. So what they do is they get 500 million bucks at a time from the bank via this big sort of overdraft. And it could be banks here in New Zealand or overseas, and they lend out the money. And when they get close to their overdraft limit, they package up the loans and they sell them on to institutional investors, for example, the New Zealand government. And then they take that money that they get from selling them, pay back the overdraft, take their profit, and then they start all over again. So that's kind of how they fund. So they don't take deposits from the public, like the finance companies that failed, and there was a lot of them. There was something like 70 or 80 of them. So the things that they'll do, they'll do 80% on investment property and owner occupied. They have an easier debt servicing test rate. So the banks use rates sort of in the 7s, and they use a rate at 6%. So they're a bit less strict in their assessments. They're still going to comply with the Responsible Lending Code and the Triple CFA, which is the Credit Contracts and Consumer Finance Act. But the rates are good. You can get a 2-year fixed rate at 3.39. The floating rate's actually a whole percent under the banks at 3.49% at the moment, so that's pretty cool. And they don't have any big upfront fees or exit fees or anything like that. So, and importantly, borrowing for business purposes are okay. So if you need to pay a tax bill, they're happy to do that, whereas the banks don't tend to be all that keen on that. And also, if you want to get some working capital for your business to get through this next 12 months, they'll be fine with that. There's other non-bank lenders who have been signing off new funding lines during the lockdown, so it's pretty encouraging. And then sort of going down the chain, you start getting into more expensive lenders that will do different things. But there's lenders out there that will do $100,000 unsecured loans for any business purpose, and so you don't have to give them your house as security or your car or anything like that. So completely unsecured. The rates are probably going to be double digit, but they've got no security, and you can use the money with for anything that you want in your business, and you can get it within 24 hours. So so it's pretty handy. So there's a whole range of lenders out there, and they're all open for business. But that's quite different to the global financial crisis. There just wasn't a lot of options back then. They all had their funding pool, but that's not the case this time around.
Yeah, that's really interesting to hear, Brett. And I suppose it's good to know that there are other options out there for not only personally but for business. So that's really good to hear.
Yeah, absolutely. Yeah, the non-bank sector in New Zealand, it's reasonably small. They don't tend to go out and advertise to the public. Most of it sort of done through advisors.
Yeah, good. Hey, I've just got a question here come through from Steve. I thought I might just ask you straight away here. So, commercial lending and the banks, is that still all go or a no go at the minute?
It's still an option, but banks are very nervous about the ongoing income of commercial properties with the lease income, and also the values of them as well, because with the commercial values are very closely linked into what lease income's coming in. So there's it's a different kettle of fish to the residential side, and banks are certainly more nervous about it. Yeah.
Yeah, I suppose it's just based on case by case analysis and just keep talking to your advisors and seeing what options are out there, I suppose.
Yeah, absolutely. If it's all looking solid, then banks will do it. But you're going to have to provide a whole lot more information than what you otherwise would have. Yeah.
Yeah, that's good. So yeah, just to the next slide. So the Reserve Bank of New Zealand has removed the LVR restrictions for a period of 12 months. So what were these restrictions in the first place, Brett?
Well, when you look at LVR, that stands for loan to value ratio. So that's basically the balance of your loan divided by the value of your property times 100. So and that's one of the key cornerstones of mortgage lending. It's one of the first things that any lender or bank is going to look at. So what they were on the owner-occupied side, so no more than 20% of a bank's lending could be to those who have less than a 20% deposit or equity. And on the investment property side of things, no more than 5% of a bank's lending could be to property investors who have less than a 30% deposit or equity. So important to note that investors have always been able to borrow 100% of the purchase price for rental, as long as they have enough equity and other properties to tap into. But yep, that's been removed now for at least 12 months.
So what does this mean for the property market then? Is it going to be easier to get low deposit mortgages now?
Well, just because you can do something doesn't mean you will do it, and that stands for the banks as well. So I've spoken with senior managers at most banks about it over the last week or so, and when it comes down to it, they're going to be very wary of lending more than 80% of a property's value. We've got potential value drops coming. We're going to have a lot of people in shaky income positions. They might not even know it yet. So low equity mortgages, which is essentially anything with less than 20% deposit, they'll only be given to applicants who the banks are very confident in. So what banks are going to be looking for is people who are in stable employment, in an industry that's strong to cope with the recession that we're finding ourselves in. They need to have excellent debt servicing capacity, low levels of short-term consumer debt, a good savings history, good credit history, and excellent bank account conduct. So no missed payments, no unarranged overdraft fees, that sort of thing. Likewise, the banks are still considering their positions on where they'll go with investment loans. Kiwibank's the only ones that's confirmed that at this point they'll go to 80%. The others aren't quite sure what they're going to do just yet. But I think the biggest winners out of the restrictions being dropped will probably be people looking to purchase investment properties, and those who are looking to purchase a new owner-occupied home and maybe turn their existing home into a rental. It's going to be easier for them. So it will be of benefit to purchasers, and the property market will benefit overall, but I can't see it being a free-for-all like you're seeing being reported in the media.
Yeah, so I've just got a question come through, Brett, if I can. So what do you think will happen after the 12 months? Will they drop investors at 80% or not?
Yeah, hey, it depends on what happens with the property market. I think if it all goes all guns blazing again, I think they'd bring them back in again because it has worked really well for them. But if the market's just sort of limping along, I can't see them bringing it back in again until it sort of takes off again.
Yeah, right. Okay. Watch this space, I suppose, to a certain degree.
Yeah, absolutely, but they've put a date on it at the moment, and it'll be reviewed at that time.
Yeah, that's it. That's it. So in this new environment, is there anything that people should be keeping in mind when they're applying to banks for mortgage finance? And what about in general when signing up contracts on properties?
Well, I'm not sure how it's going to work in level 2, but at the moment, real estate agents are only allowed to do 2 viewings of per day of a property, and so what they're telling me is that they're only wanting to take strong purchases through properties because they don't want to waste these limited viewings on the tie kicker. So get pre-approved, that would probably be a good start. If you already have a pre-approval with the bank that was arranged before the lockdown, it may not be honoured today. So you need to check in with your bank or your broker about that. So what we're finding is that banks are asking for reconfirmation of income. So for PAYE people, that could be a letter from the employer. For self-employed, it's the forecast and all that kind of stuff. So yeah, what that piece of paper that says, yep, you're approved for this much, if you got that before the lockdown happened, it may not be worth anything now. So check into that. Banks are checking the register to see if your business or the business that you work for has claimed the wage subsidy, and if it has, they're going to ask you questions about that. Bank turnaround times, some of them are taking forever and others are really quick. But like we discussed before, you're going to need to provide much more detailed info than you ever have before. So you're best to get onto it early if you're thinking about buying property. Another thing, banks have their own debt servicing calculators, and they'll lend you hugely different amounts of money per dollar of income you have, and also for your personal expenses and your family situation. So we often find that where bank A might approve 500,000, some of the other banks might approve 700,000. So the differences between them are huge. So it pays to shop around. I think at the moment, very important to avoid long settlement periods. I get asked quite a bit about long settlement periods, and when you think about it, mortgage approvals at present are valid for between 60 to 90 days, depending on your circumstance and the bank. And then the loan documents, once you've secured the property and settled on your mortgage structure, the loan documents with some banks are only valid for 60 days. So if you go for a long settlement period, then you're basically you could be risking your deposit that you pay into the agent's trust account when you go unconditional on a property. So try to keep within 60 days between the unconditional date on your contract and the settlement date. I think that's really important at the moment. And I guess something to have in your heads is, lending criteria is changing very rapidly right now. So don't take a she'll be right approach. That would be a bad move at the moment. Something that we see a lot is unconsented work on properties. And just before this webinar, I had a call from someone who signed up a contract, and there's an unconsented carport. So that's if you're looking at properties, that should be one of the first things that you're asking the agent or the vendor: is there any unconsented work? And there's a lot of it out there. So the key to that is that insurance policies on dwellings these days will have in the fine print that any unconsented work or damage that arises from the unconsented work is not covered. That's not going to be good enough for the bank. So this has been really problematic for us for the last few years, but in this sort of environment, banks are going to become a whole lot less likely to take on defective property. So really look into that. And I guess my final point on that, in this sort of environment, don't assume anything. Double check everything, and make sure you seek good quality legal, accounting, and financial advice when you're looking at these things.
Yeah, that's really good to know, and quite eye-opening, some of that stuff that you have to work through. But knowledge is king, and the banks are going to want all of that knowledge as well.
Yeah, Absolutely, and with that unconsented work stuff, particularly around the central Auckland suburbs, there's a whole lot of it in there, and the properties might cost $2 million, but they're full of unconsented work, so you really got to look out for that.
Yeah, that's good. Hey, I'm just getting through a couple of these questions as we go, Brett, if that's all right.
Yeah.
So here's one here. What is the likelihood of being approved for borrowing as an overseas-based borrower? So it's a Kiwi looking to move back in a couple of years, as an example.
Yeah, we've been getting a few of those approved during the lockdown. There's a lot of Kiwis looking to come home in the next few years. So if you're self-employed overseas, that's going to make life a whole lot harder. But if you're on a regular PAYE income, then yes, that's doable. And every bank has completely different criteria with that. So we find that we tend to have to shop them around a little bit. But yes, that's completely doable. You'll have to be providing really good commentaries on what's happening in your country and all that kind of stuff.
Yeah, no, that's good to know. Good advice. So yeah, interest rates. A lot of talk over the last week or so. So what's happening with the interest rates, Brett, and where do you see them going from here? A bit of crystal ball gazing.
Yeah, I'll just put that magician's hat on something. The new benchmark for rates is now 2.99. We're solidly in the twos. Who would have thought? So you can get 1 and 2 year fixed rates for 2.99 now. It is crazy. Yeah, we would have never thought that a year ago. Last night, TSB Bank came out with 2.89 for 1 year. So not all banks are advertising rates like that, but the main banks are open to giving it for 1 and 2 years with a bit of negotiation. There's a couple of outliers like the China Construction Bank. They've got a 1 year fixed rate at 2.8. It's pretty amazing. I mentioned cash earlier. Some banks are giving cash backs and some aren't, and they're ranging from nothing up to 0.55% of the loan amount. Important to note that the cash will typically tie you in for a 3 to 4 year period. So if you go to leave that bank, they're going to ask you for some or all of that cash back. So if you're looking to refinance to another bank and you've taken cash in the last 3 to 4 years, you need to look into that. Otherwise, you might get a big surprise on the day you go to leave them. Sometimes it works out better taking a slightly higher rate and a bigger cash amount. So it's important to work all that out. And interest rates are really important, but I wouldn't get too caught up with chasing 0.1% on a rate. The real dollar savers when it comes to mortgages are structuring your loans well. So that's the most important thing to me. I think rates are going to stay low for quite some time from here. 2 to 3 years, I think, is pretty likely. Around the world, governments are going to be setting their monetary policy to stimulate economies, and the base rates, such as our OCR, cash rate, they're going to be kept low for quite a long time. So, whatever's happening in other countries with interest rates, that does have an impact on our mortgage rates here, particularly the fixed rates, because some of the fixed rate money that the New Zealand banks lend out here in New Zealand is sourced from offshore, and primarily that would come from the US and the UK. So I'm favouring 1 year rates at present, and like I mentioned, 2.89, 2.99. You can review those in 9 to 10 months' time and get a plan together at that point. So with a 1 year rate at the moment, you can react quicker to the market, and we're in a crazy time. No one knows what's going to happen. So you can, before too long, you can decide, okay, I'm going to fix long now, or I'm going to go short again and just roll it again. If things really go crazy, you can break out of it easier if you need to without such a big cost. But it really is going to be different for everyone, so important to take advice on it. Been seeing a bit of chatter in the financial websites about the OCR. It may go negative. So what impact will that have on rates if that happens? So the closer the OCR gets to zero and below zero, the less the fixed rates will be impacted by a cut. So, when we saw the 0.75% cut to the OCR not so long ago, the fixed rates didn't move too much. The floating rates moved by a whole 0.75. So, banks still have to attract deposits in from savers, and if they put the mortgage rates lower, they've got to lower the deposit rates, and people aren't going to be keen to save money in the bank. So they've got to be very wary of that. But yeah, we could see lower fixed rates coming later on in the year, I think.
Yeah, that's good to know. I've got a quick question here. Can you remind us which banks are giving the cashbacks at the minute, or is it across the board?
So what we've finding that ANZ is getting the most cash at around about 0.55, and then it sort of goes down from there. But most banks are the likes of your China Construction, most banks with those really low rates. They're not tending to do much cash. HSBC Premier have some pretty fancy rates, and likewise they don't do a lot of cash. But most of the big banks will do cash, and then some of your smaller New Zealand banks, they're doing sort of lower amounts of cash as well.
Okay, yeah, that's good to know. Just got to keep asking the questions, don't you?
Yeah, absolutely. If you don't ask, you don't get.
Exactly. Again, we'll get you to put your magician's hat on and crystal ball gaze again, Brett. It's on people's minds right now. Is it a good time to buy? Is this an opportunity, or should people wait? What's your take?
Well, Justin, I think the answer to that question is going to be quite different for everyone. Really, to me, I think the biggest factor to consider right now is the stability of your income. This is the most uncertainty any of us have ever experienced before. I guess if you're in business and if you haven't put a lot of thought into how your business might be affected over the next sort of 1 or 2 years, and you haven't done robust cash flow forecasting, then I'd say taking on a new debt right now to purchase a property probably isn't the A move. Likewise, if you're an employee and you're not 100% certain your job's safe, you'd probably be pretty brave to take on a new debt right now. But I guess let's assume your income's looking stable over the next 12 to 24 months. Is this a good market to purchase in? Well, I follow Tony Alexander, and a lot of you probably do. He was the chief BNZ economist for 25 years, and he's recently independent. I think he summed it up pretty well in his latest report. He had an elevator pitch. So someone asked him, "Hey, you're that economist bloke, the house prices, they'll crash, eh?" Munted big time. And Tony's response to that being, "Well, what do you reckon happens to house prices in a downturn when 1/3 of properties have no mortgage? The home ownership rates are low, 62%, mortgage rates are at record lows, investors buying these past 4 years have needed a 30% deposit, and the bulk of people likely to be made unemployed are young, don't own a house, and haven't been able to buy because of a shortage of listings." So he's thinking property values probably won't drop too much, but everyone's thinking differently. So what I'm seeing on the ground is the market's actually really busy right now, and actually spoke to a lawyer just before coming on the call, saying that he's just had a whole lot of contracts come in for properties. I've done finance updates for 10 or so real estate offices in different parts of New Zealand over the last few weeks, and generally agents are reporting really high levels of inquiry at the moment. They're doing lots of property dealings, they're signing up a few contracts. Me personally in my business, the level of inquiry coming through is quite high at the moment. The first 2 weeks of the lockdown, it was almost all panicked people looking to ease their mortgage payments, but now it's new applications and it's all happening again. But I just get the feeling that this could be the housing version of the KFC queues. Everyone's been sitting on their hands and they just want to get out and start doing things. But really, I can't see it lasting. So I reckon give it a few months. Coming out of lockdown, it's boosting people's spirits, and people are going back to work and they're getting more positive. But it doesn't change the fact that we are in a gnarly recession, and it's going to take businesses probably quite a few months to work out where they stand in the new economy. Can they keep staff on? Can they keep the doors open? I think this is just the beginning. I think the mortgage holidays will avoid forced property sales for some, but they'll only defer it for others. So I think we probably won't see the true impact of this on the economy and the housing market until the end of the year. So October, November, December, something like that. So yeah, hey, there's a quote. It's hard to make predictions, especially about the future. But if you're looking to pin me down, I'd say the optimum time to purchase will probably be around October. That's when I'm going to look myself. Reason for that, mortgage holidays coming to an end, businesses understanding their positions. You as a potential purchaser, you'll have a better idea of where you stand then. But if you are looking to purchase now, I think you can still do well. So take a view on where values will go. Every economist out there's got their take on that. Me personally, I'm thinking probably 10%. That's where it was in the GFC. So if you that 10%, that's going to be 10% down on where we were in January and February. So if you negotiate well enough now, you can take a lot of the sting of that 10% out now. So if the right property has presented itself to you and the time's right for you, then go for it.
Oh, you there, Brett?
Yep.
Oh, you just cracked out there for a second, but no, that's look, it's so difficult to predict, but I think you're right. There may be still a little bit of pain to come for people's personal lives and their businesses. So time will tell to see if that sort of flows on to any property downturn as well.
Yeah, Alistair at BetterCo, he put up a really good graph from Westpac on his LinkedIn the other day, and they think that property values are only going to drop by 7%, and it's going to recover quite quickly. So go into Alistair's LinkedIn and have a look at that graph. That's quite interesting.
Yeah, that was very good. Yes, okay. So a lot of people will be seeing these rates in the twos, late twos, and wanting to get out of their current fixed rates. How do they go about that, Brett?
Well, these rates are a real godsend to people right now, and they look pretty attractive, especially if you're in something on the fours. But the problem with it at the moment is that the break costs to get out of your current fixed rate are really high. And we've got a calculator that we've developed where we can put in all the numbers. It clearly shows, is it worth it or is it not? And in most cases, we're finding that it's proving to not be worth doing the break. But I think it's worthwhile looking into. The cash contributions from new banks do take the sting out of the break fee from your existing bank, so that can make it worthwhile. With the cash contributions being a little bit lower at the moment, it may not be worthwhile, but as time goes on and those cash contributions go up, you'll probably see the refinance market start to take off again in the coming months. We have had several cases during the lockdown where we've actually managed to negotiate cash from the client's existing bank to help with the break cost, but don't go out expecting that. That is very rare. I was pretty happy to pull those off. But yeah, refinancing to better rates, that can take significant payment pressure off people. So if you look at say a $500,000 principal and interest loan, paying 4.35% over a 25-year, then the payments on that are just over $2,700 per month. And if you get a rate of 2.99, then it goes down to just over $2,300 a month. So it saves about $370 a month for that situation. And then if you turn that into interest only, then that person's payments could go down to $1,246 a month. So that lowers that person's cost by almost $1,500 a month. So that could be quite useful to a lot of people right now.
Yeah, that's really good to know. Yeah, there's some big numbers, and I suppose with the calculators that you guys have, you can work those amounts out pretty quick, right?
Yeah, absolutely. And just put the numbers in front of people so they can make a clear, informed decision, rather than just sort of going blind and hoping it's the right thing to do.
Yeah, no, makes sense. Makes sense. So, as we keep saying, we're in a very strange time and anything could happen. Is there anything that you can think of that mortgage holders could do to protect themselves at the moment?
Yeah. So banks are going to be keeping a very close eye on equity levels for the portfolios over the next 12 to 24 months. So, and I guess this is a bit on the extreme side, maybe a bit alarmist. So take it with a grain of salt. But if you're a safe over sorry sort, over the next 12 months, if you have all of your savings stored in a revolving credit mortgage and you don't have a lot of equity in your property, then you may want to consider withdrawing those funds and putting it in a bank account with a different bank. And then either just leave that revolving credit fully drawn on a floating rate, but make sure you arrange a good discount on it, or convert that loan to a term loan and then fix it at say 2.99. And the reason I say that is that during the global financial crisis, we saw some borrowers, they had their revolving credit limits reduced or cancelled because the bank was concerned about the equity level, and basically that left them with no money. So to give you an example, a current client of mine, she's a senior executive in the mortgage industry. She was then, she is now really well known. She was told by her bank during the GFC that the value of her property had dropped, and that if she wanted to keep her revolving credit, then she had to get a registered valuation to prove that her property value was higher. So she did that at her cost, and the valuation didn't stack up. So the bank cancelled the revolving credit facility, and that took all of her money and all her savings. So she was forced to sell her home in a buyer's market, and it took her many years to recover from that. So that's a pretty extreme example,
Wow.
but it could be something to look at.
Well, you just don't really know
That sort of
those sort of examples. So yeah, sometimes it does sound a little bit alarmist, Brett. You're not wrong, but you just need to know that these things do happen and have happened.
Yeah, like you say, it's a strange time. Weird things are happening, so it may never happen, but be careful.
Oh, are you there, Brett? I think we've lost you.
I'm here. Can you hear me?
Yep, sure can. Yeah. So, and also, so what about people who have multiple properties, their home and a few rentals, for example?
Well, if you have multiple properties, then it's generally a good idea to look to spread them out with different lenders. In lending, we have this thing called cross collateralization, which is a bit of a mouthful. But basically, what it means is that if you have all your properties with one bank, then if say you've got one rental where you've got a bad tenant and you can't get them out, they're not paying any rent, and that one fails and you can't keep up the mortgage payments on it, it gets taken to mortgagee sale, then the bank can actually sell any or all of your properties at mortgagee sale. So it's times like this when these sorts of things get exposed. So if you split your mortgages up and your properties up, and you go to different banks for different properties, then if one of them fails, the bank can only sell the property it has as security in that scenario, and your other ones are safe as long as you keep your payments up on the other ones. So I'd say at the least consider having your owner-occupied home with a different lender to your rentals. So protect the family home. It would be a lot less stressful for you to lose a rental property compared to your home. And I find that a lot of investors have got enough equity to actually have their home left completely out of the picture. But the bank does still have it as security. So review it, see if you can have your home discharged as security and have it encumbered. The easiest option as you're building your property portfolio is to be with one bank, but easiest doesn't always mean best. So, a common trigger point for property investors when they contact me is they may have sort of 3 or more properties. They've got more with the same bank, and they've decided to sell one, and they've got designs for what they want to do with that money. And then the bank tells them, no, you need to use the proceeds of that sale to pay down the debt you've got with us. And that really upsets them. And then they want to start diversifying to other banks. So, people think the more borrowing they have with a bank, the more that bank will want to do for them. And yes, that is partially true. But banks would rather have lots of small borrowers than a few big ones because it spreads their risk out.
Yeah, that's really good advice, Brett. Very good. Okay, well, I think have you got anything to add there, Brett?
Yeah, I guess a few tips. A few tips to sort of prepare yourself better for next time. This won't be the last time we experience a financial shock. You can look to set your mortgage or your mortgages up to have some flexibility, and some banks are more flexible than others. So I don't know about the audience tuned in today, but I know most of my clients aspire to pay their loans off as quickly as they can, so they can achieve financial freedom. So and they tend to want fixed rates and not floating because the fixed rates are so much lower. But some banks have limited tolerance for overpayments on fixed rates. So I find people end up taking short-term loans or short loan terms with their bank for their mortgage to get it paid off quickly, and that locks them into large payments. And people that have done that in this sort of environment are kind of regretting that. So what can be done? Some banks will actually let you take a long loan term. So they'll let you take a 30-year loan term, but then they'll let you set the payments at a much, much higher level, so you can, say, achieve a 10 or a 15-year payment time. And then if something like this comes along, it's within your power to easily reduce your mortgage payments back down to the minimum. And then some banks will actually let you redraw the amount that you've overpaid as well. So, when something like this comes along, if you had been paying your mortgage back at a really fast level, and then you could reduce it back really easily without having to get approval from the bank, and then sort of tap into this big amount that you'd overpaid, that'd be pretty awesome right about now for a lot of people.
Yeah, that's very good advice. Just having that flexibility around those repayments, yeah, it's good.
Yeah, absolutely.
Very good. All right. Well, I think we're sort of coming to the end now, and we're just ticking over an hour, so that's pretty good. As far as questions go, I've sort of been asking those as we've gone along, which is very good. So there's only one really here that is quite specific to individual circumstance. So I suppose for those people that just need to work through their individual situation, they just need to make contact with their advisors and work through those.
Yeah, we could that particular question, we could take that one offline and work through that. But yeah, it's crazy times out there. So get in touch with your respective advisors and get as much advice and knowledge as you can at the moment. It's really important.
Absolutely. And so to that point, if people do have any other questions that they want to flick through after the webinar, feel free to send them through. There should be like a feedback form on the exit of this webinar as well. So if you could all complete that. But for the attendees, I'd like to say thank you for attending, and a special thanks to you, Brett, as well. Some really good knowledge there, and hopefully people have been taking notes. But if they haven't, this will be available via YouTube. So we'll get a recording of this and get it up so people can revisit, and we can share this out with our clients as well. So thank you for your time. And Brett, thank you for your time as well and your knowledge.
Thanks for having me.
Very good. All right. Well, I think that's it. Thanks, Brett, and thanks to everyone, and we'll be in touch real soon.